Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Company loans, we've seen it everywhere. It's on Facebook, it's on Instagram, it's on every Finfluencer's page. Great ways that you can move money from one entity to another, but you also need to consider the implications involved. I'm going to go through and explain to you today what an actual company-to-company loan is, the benefits of it, and what are some of the negatives of it as well. It does involve moving money from one entity to another. It involves then buying assets, and there are some trade-offs that come with it. So I'm going to explain to you today, and I'm going to use my trusty pen and Surface tablet today to go through that with you and just go through some of what the pros and cons are of company loans. Now, in one of my recent episodes, we spoke about Division 7A and the nasty pitfalls around it. Again, that is when you as an individual are drawing money from your own company to go use to spend on personal items or to buy investments. And there are things that need to be considered for argument's sake, like paying that money back with interest, which may not necessarily be deductible in your name and accessible in your company's name. You need to make sure that you make the minimum repayments by the due date. And if you don't, you run the risk of unfranked dividends. But believe it or not, there is no Division 7A loan that is created when you move money from one company to another. And that's the benefit of having company-to-company lending, because it sits as a receivable balance, meaning Company B owes money to Company A. Company A is receivable of the money that it's given to Company B. So one sits as a debit, the other one sits as a credit. Anyone out there who's a nerd that loves their debits and credits, a debit means the money's due back to that entity, credit means the money's payable to another, a loan essentially. But what we like to do as accountants is we really need to consider and understand the financial position of the individual. We need to understand what their goals are. We need to make sure that we're creating the right structure to ensure that we're not implicating them from a tax position later on in the future. So a couple key things to consider around a company if you're looking to do company-to-company lending for assets. First thing to consider is a company receives no CGT discount. So very important, unlike say for instance a trust that distributes to an individual beneficiary or an individual that buys an asset and holds it longer than 12 months, the beneficiary who is an individual or the individual for argument's sake, if they bought it in their own names, they will receive a 50% discount, meaning they'll only pay tax at their marginal rate on 50% of the profit. Now, for argument's sake, worst case scenario, if they've made $100,000 and if their marginal tax rate's 47%, they will pay 23.5% tax on the 100 grand, $23,500. That is the worst case scenario, where if you make a gain in a company, the company may have to pay tax at 25 or 30%, depending if it meets active or passive tax tests. So very important to understand a company does not receive a CGT discount. Tax at the tail. Tax at the tail. Not many people talk about tax at the tail, and this is a colloquial term that a lot of accountants will use. When a company pays tax at 25 or 30%, that is a franking credit. That's moved from cash at bank in the company's name to now a franking account balance that sits inside a pool in the tax return that the ATO are holding on your behalf. Now that tax at the tail means if you ever need that money in the company and you want to use that for personal expenses, you need to now draw that money out as a dividend to the shareholder of that company. Remember, that second company that's been established to receive money from the first one to go buy assets, company letter B. Now, what tax at the tail looks like. You may be a high income earner already where you're the one that's going to be receiving the fully franked dividend. It means that yes, you may have paid tax at 30% on that profit that's been derived in company B, but when you draw that dividend out, you'll now need to pay tax at 47%. And that means there is a 17% top-up tax difference. So it's very important. Not necessarily does it mean that I, buy inside a company, I make money, I make a gain, I pay the tax of 30% and that's it. I can take the money out and do what I want to do. Again, refer back to my prior video about Division 7A loans and you'll understand the concept. So you do need to factor in that there might be tax at the tail, which means rather than you getting a 50% discount and paying a worst case scenario of tax, if you held the asset for longer than 12 months of 23.5%, you could be paying a worst case scenario of tax of 30% in the company and a further 17% in your name, which totals 47% tax. So that's very important that you understand the concept of tax at the tail. Now, if you're not going to sell, for argument's sake, houses that you've bought in Company B that you've received from Company A, then there's no tax implications. You'll be paying tax on any earnings that it generates at, for arguably 30% in the dollar. Let's use that as an example for this one. It will continue to accumulate profits, otherwise known as retained earnings, and it will continue to build up, and you can use that money then to buy other investments later on in the future. But soon along the line, there's going to be a time where the money inside that company is needed, and that's where strategy comes into play. Depending how you structure Company B, and ideally you may have structured it with a trust being the shareholder, then it is a great way to then get dividends out of that company to other beneficiaries that are paying potentially less tax than yourself. So people otherwise know that as a bucket company when they get distributions from a trust to a company. In this particular case, it's company to company lending. It's important to understand there's no Division 7A loan between company to company. So again, Company A can lend to Company B. It's important to understand that Company B will then invest that money, maybe buy properties, it may buy other equities or annuities, whatever it may be. It will pay tax, typically at 30% because of the passive tax rate test. And then if you want to get that money out of the company in the future, you need to be careful that when you're getting the money out, what tax rate are you paying as a marginal tax rate payer? Are you paying the 47%, which means there potentially is a 17% top up? So it's important to understand the tax at the tail could be the disaster that gets you where it may have been worthwhile to buy that asset, for argument's sake, with inside a trust or a company. But what are the pros of company-to-company lending? The biggest pro of company-to-company lending is its ability to have more of the retained earnings going towards the asset. So let's just use this as an example. If I've made in Company A $1,000 and the tax rate on that profit is 25%, I have now got $750 to be able to utilize in the business for business purposes. So I've got really good after-tax amount of money. I then move that $750 to Company B. Now Company B has that $750 to invest in a property. Now the argument is, well, Jeremy, 25% tax, I can leave the money in the company, it's going to do that anyway. If, however, you were to draw, for argument's sake, that $1,000 of profit out of the Company A as a wage, let's get here, Company A, $1,000. We draw a wage of $1,000. Therefore, profit is now zero. But on that $1,000 that you've drawn as a wage to yourself, let's say for argument's sake, you've lost $400 in tax. So you now only have $600 of after-tax money to invest in property. Compared to if you moved that money and left it to be taxed inside the company at 25%, you moved that retained earnings to Company B, you would have had $750 to invest. So an extra $150 gets to be retained with inside Company B for future investment. So you've got to understand the pros and cons. Now, if it's me, and I don't like to give too much advice, but if it's me, if I'm looking at assets where I'm wanting to use, say for argument's sake, company's money, and those assets are really factored around lump sums of growth. I mean, I'm buying in, trying to pick the hotspot, I'm buying in high growth areas. I want to be looking at properties where it's going to grow by $200,000, $300,000, $400,000 in a short period of time. I'm actually going to be looking to not invest via company to company. And the reason for that is I'd rather take the money out via way of a dividend or a wage, try to do it the best way I possibly can, and then invest that money into a trust or give it as a loan to a trust for argument's sake, let that trust invest in the property. It grows by $300,000, $400,000. I get a 50% discount on the capital gain that's been made because I've held it longer than 12 months and I've been able to distribute it to the beneficiaries to save the most amount of tax that I can. But if I'm focusing on a cash flow asset, Jeremy, I'm just looking to buy, say for argument's sake, maybe a commercial property or some shares, then that's when I could consider using some lazy retained earnings in a company and passing that maybe to company B, and company B uses that higher amount of cash after tax to be able to invest in those cash flow assets. Now, the reason for that, not a huge amount of capital gain, so I'm not too worried about losing a 50% discount. And further, I'm getting the environment of the profit being taxed on those investments that I've made for cash flow purposes, being taxed at 30%, as opposed to them getting taxed at maybe my marginal rate, or maybe through a trust, which then has to be distributed to the beneficiaries, which I would have distributed it to a bucket company anyway. So they're the things that you need to consider. If you're focusing on really chunky capital growth investments, it might be worthwhile to pay the tax, invest after tax money into the asset. Or if you're looking at very cash flow orientated investments, that's where maybe company to company lending could play out to be the best result. If you like what you're hearing, don't forget to like us on iTunes and Spotify. Hit like and subscribe on YouTube. I'm Jeremy Iannuzzelli. That is what schools should have taught you. I'll see you next week.